let's kick it off. First off, you are here to learn about non-recourse loans. Maybe if you're on this call, you have no idea what a non-recourse loan is. Maybe you do. I don't know. Most people I talk to think they know what a non-recourse loan or actually have never heard of it. But when they think they know what a non-recourse loan is, they often think it's just a DSCR loan, which it's not. In some ways, it's similar, but it's not a DSCR loan. It's a non-recourse loan. Our guest is going to dig into that. Before we do, I'm going to give just a little bit about what we do here at Sense Financial, and then I will kick it off. I'm not going to go too long because I want our guest to have as much time as possible. But the topic today is, how do you know what non-recourse loan is right for you? I'm Brett Sinitsky. I am a consultant here at Sense Financial for the only two products we do, which is the checkbook IRA and the solo 401k. We're not a fiduciary. We don't provide legal or tax or investment or accounting advice or other professional advice. In fact, my guest here is not here to provide that advice either. We're not attorneys. We don't even play one on webinars. If you need legal, tax, investment, accounting, or other expert advice, please seek out the proper professional. Sense Financial, if you don't know about us, we're a boutique financial firm that specializes in self-directed retirement plans. That's our niche. Our niche within the niche is that all of our plans have what's called checkbook control. Not going to get too far into that, but just suffice it to say that you can either go through the custodian for all transactions, all investments. The custodian signs on the dotted line for benefit of your retirement account, or you can bypass or in some ways eliminate that process, eliminate the custodian or bypass the custodian and perform all transactions, sign on the dotted line yourself, which can be a much more efficient way to invest your money into alternative assets, non-public assets outside Wall Street, which of course is what most of our clients are looking to do. We've been around since 2010. In fact, our guest here, Mark, has actually known Dimitri for about that long, since he started the company back just about 15 years ago. So way past the startup phase. We have clients who have given us 5-star reviews all over the place, so you can check those out. And most of our clients come from referrals, and most of the referrals come from our clients. We have referrals that come outside the clients, of course, from CPAs and other tax advisors, people who operators of syndications and other investment opportunities, mortgage funds and such. But by far, the most referrals we get, which we more than appreciate, come from our existing client base, which we currently have over 4,000, and we've helped them establish over 5,000 different types of self-directed retirement plans, whether it's checkbook IRA, Roth and traditional, or solo 401k. So just some high-level benefits of self-directing through an IRA or 401k. I mentioned this already. You can invest in alternative assets, which provides true diversification. You're not just stuck in Wall Street, whether it's stocks, bonds, mutual funds, or ETFs. There's nothing wrong with that. But as a strategy to say you're diversified, you're not truly diversified when the IRS actually allows you to invest in almost anything. Actually, anything except for collectibles and life insurance inside of an IRA, S corporation stock, because you have to be a human to do that, and then also just certain disqualified parties, which is basically you and your immediate family. So I'm not going to go down a rabbit hole on that right now. We may touch on that throughout our presentation. And then the returns are either tax deferred in a traditional type of plan or tax free in a Roth. Solo 401k has Roth and traditional built in. An IRA is either Roth or traditional, but they're not combined, and you can self-direct any of those types of funds. You can use, which is our topic here today, you can leverage your funds with what's called non-recourse financing. So when's the last time someone, as you're thinking through this, when's the last time someone offered to loan you money to invest in more S&P 500? Sure, you could trade on margin. That's different than what we're talking about here. But traditionally, no one's going to give you money to invest in more S&P 500 or Apple stock, okay? You can, however, leverage your IRA funds with what's called non-recourse financing to buy 70, 60, 50% more real estate if that's your aim for your retirement plan. The checkbook control we talked about, not going to belabor that. And then the solo 401k, we actually call it the ultimate retirement plan. It is a true tax shelter. You can actually contribute up to $81,250 annually as either Roth after tax or traditional pre-tax or a combination of the two. Whereas an IRA is only $7,000 or $8,000, and the 81,250 is a number that you can achieve at a certain age. If you're under 50, it's $70,000. Okay, if you're over 50, it can go up to 81,250 with some certain nuances that I'm not going to necessarily dig into right now. But it is a true tax shelter. So much money can go into the solo 401k. It's awesome. And then I mentioned the unlimited investment options already. These are just some of the more common ones: residential real estate, commercial real estate, tax deeds, trust deeds, precious metals of certain grade and quality, cryptocurrency. That's the hot thing now. You can do that in your 401k and IRA. It can actually own the crypto as opposed to just investing in a crypto ETF, which there's a lot of debate about. So you can do that in your plan. You can become the lender. You can do private lending, become the bank, not you, but your IRA or 401k, and just almost unlimited investment options. Okay. Now, that aside, I mentioned true diversification, and we definitely don't want to be like these elderly people here where they put a dozen or more eggs in one basket and drop the basket and a bunch of the eggs broke. They didn't all break, but a lot of them broke. Okay. And if they had them in multiple baskets, obviously if they dropped one, only those eggs in that basket would be subject to breakage. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And that's so true. Mark, who's been around longer than I have in this industry, we've seen ups and downs. Of course, the most recent was COVID, which was just a little blip, even though it was a crazy thing to happen to the whole world, but it was just a little blip, and then real estate went bonkers. The stock market went bonkers. Of course, 2008, 9, and 10 in that range was the Great Recession. But if you were diversified, if you had, alternative assets, you probably weren't hit quite as hard if you were just kind of stuck in Wall Street, or just by choice, or maybe you didn't know better, had all your investments in Wall Street. Okay. So with that said, I want to get out of the way and introduce our speaker here, Mark Robbins, founder of Lending Resources Group Incorporated, has been a pioneer in non-recourse financing for IRA and 401k investors since 2004, maintaining relationships with a few banks that offer these specialized loans. He's actually a preferred provider for major IRA custodians around the country, including SenseFinancial. He's actually listed on our website and on the lender page, which you can find under non-recourse lenders. Mark has facilitated non-recourse loans for investors in over 30 states with a JD from Western State College of Law and a BA from NYU. Mark's 40-year career spans real estate investment, development, and mortgage banking, generating over $176 million in residential and commercial loans nationwide. And with that said, let's welcome Mark. Thank you very much, sir.
Wonderful. Well, thanks for that introduction, Brett. And Brett is correct in that I've been around on this earth a little bit longer than he has as well. My lack of hair proves that, or the color thereof. So, there's a lot to cover on the subject matter of non-recourse loans. And I think you'll see the PowerPoint pop up.
There you go.
And, we can look at the first page, and, it talks about what you can not invest in. The IRS publication 590 tells you what you cannot invest in, but it doesn't say you can't invest in real estate. And ever since people have been investing in real estate, prior to 2004, as Brett pointed out, there was no such thing as a non-recourse loan. you could buy real estate with cash or with your IRA cash, but you could not leverage it. You couldn't get a mortgage. And then there was a bank in the Midwest. Most people know about North American Savings Bank. I don't reveal my sources other than to say they were the originator of the non-recourse loan program. And that's when I got started as a mortgage broker. I'd been in the business a couple years prior, starting in 2002. Actually started my career with Bank of America as a residential loan broker. And when I met the chairman of the board of a custodian company by the name of Pensco Trust out of San Francisco, he said, "Why don't you get involved in non-recourse financing?" Well, at the time, I didn't even know what that meant. Well, very simply, a non-recourse loan means that you can borrow money with your IRA from a bank that provides those types of loans. And if for any reason that loan is defaulted, the lender cannot come after you or your assets to collect the balance of that mortgage. They can only seize the property or the rental income that the property produces. And that's what the non-recourse means. No recourse against the individual. And that's a law. And we're going to go to the next slide, and you can read, and during this presentation, I will let you read the slides. I know the subject matter well enough that I can summarize what it's all about. But the bottom line is that the money you're using in your IRA has not been taxed, except the Roth IRA. The Roth IRA you can invest in, and there are no tax consequences. You'll never be taxed on gains that you have within your Roth. But otherwise, at some point in time later in life, if you're going to use the money that's in your IRA to live on, you're going to be taxed. Bottom line, the tax consequences will get involved in that, but the main reason is that money in your IRA has not been taxed. So the IRS does not want you personally guaranteeing a loan with a bank, because it could be subject to seizure, it could be subject to losses, and if the IRS hasn't gotten their share, they're not going to be happy. So, hence the reason for non-recourse financing as we move along. And Brett, there you go. So, I've already kind of summarized that reasoning. And by the way, I've been doing this since 2004. My first non-recourse loan actually consummated a year later after I had established a relationship with North American Savings Bank. And, from there it's been coast to coast, north to south, east to west. I've covered hundreds of properties and educated probably thousands of people on the subject matter. And for me, it never gets dull. It's always interesting. I'll talk more about the types of loans I've been doing. So moving right along, what do we have next, Brett? On the so that also mentions the 30 or some odd states or so that I've closed non-recourse loans in, and you can read that for yourselves. I've had inquiries for Maine and Alaska, but I don't have those on the list yet. So, what have you next? Okay, so here's some of the successful non-recourse loans I've done, and they've been pretty interesting. I have to say, one of the larger ones I had was a refinance of a 32-unit apartment building. And actually, the story behind that is interesting because that was not one of the traditional non-recourse lending banks that is on the list with SenseFinancial, for example, or in my portfolio of lenders. That was with Chase Bank. And that was the first non-recourse loan to an IRA that Chase Bank had done, and I don't know that they've ever done another one. And that was it took several months to get through their legal department, so that was kind of a pioneering achievement for me. It was, took a lot of time, but we say it was a feather in our cap. And from there you can read, I've done condos, I've done multi-unit properties all over the country, a couple in Portland there, and I did 2 5-unit properties in Washington, and row houses in Philadelphia, for example, the houses that are side by side, they literally share walls. Most lenders won't do them. I have a lender that will. Everything is very specific. And, it comes down to, I guess, having the experience of doing these things to know where to go, who is going to do what loan. That's what this is about. Some people have the time to do what I do for a living. And in that case, I'm actually competing with my own clients. So they might end up doing the loan themselves with the help of the bank, or they might ask me. And I mean, a lot of you out there, I'm sure you have tax specialists to do your taxes, even though you probably know a little bit or a lot about tax returns. But if you want it done professionally, if you don't have the time to speak with the banks, the title companies, the appraisal companies, the inspection companies, and coordinate all the activities, then that's what I'm here for. And I'm here to help. And there's nothing that I enjoy more than a challenge. We just closed a loan on a rather simple single-family residence investment property in New York. New York's a tough state to get closure on. Some banks don't lend in New York. And it took 6 months. Why did it take that long? There was a lien on the property that even the seller's attorney didn't know about or didn't clear up prior to closing. We get to the closing table, find out there's a lien on the property that hadn't been removed from the title report, and it took another 3 months to get that done. So that's, it's hard to anticipate all the permutations and changes that come along in getting these loans done. And again, that's why I do what I do as part of my overall commercial real estate financing business. So there we have it. That's on to the next thing. Okay, so here are the general requirements for getting the non-recourse loan. Look, you got to have enough money in your respective IRA or LLC or 401k to cover at a minimum 40% down payments. Reserves let's put it this way, most lenders require you have 15% of the loan amount in reserves. So for example, if your property's purchase is $250,000, 40% down is $100,000. Your loan amount's $150,000. You need 15% of $150,000 as reserves when you go to the closing table. That's $22,500. And you need closing costs. Closing costs for that transaction are probably going to be a minimum of $10,000 to $12,000 because you've got to pay the taxes that are due every time you close on a property. You have title expense, title insurance. You have prepaid insurance. You have prepaid taxes. You have the bank's fees. You have my fees, etc. So, bottom line, you need to have for a $250,000 property, just as an example, you're going to need probably $135,000 to $140,000. And if you don't have that, then obviously you have to lower your price point as to what you're going to buy. One lender in particular I have doesn't require 15% of the loan amount in reserves. They only require 6 months of principal, interest, taxes, and insurance, or as we commonly refer to, PITI. So that amount reserves eases the burden a little bit for those that need to have a good beefed up IRA for the purchase. And then, of course, the debt service coverage. Okay, so this is the other main requirement, that the income of the property exceeds the debt of the property, meaning the mortgage payment, the taxes, the insurance, a vacancy factor of 7% of the rental income, in some cases a management fee, which could be 8 to 10%, and in other cases, like an HOA dues, in the case of condos. So if that monthly debt, so to speak, is, let's just say, $2,000, then your rental income needs to be at least 20 to 25% more than that, or about $2,500 a month, $2,400 to $2,500 a month. And oftentimes that is a deal breaker for the lender. And so if that occurs, then you need to put more money down. You don't get as large of a loan. The loan might only end up being 50% of the purchase. In the case of condos, most lenders require 50% down. I'll just say that. And oftentimes you need 60% because the rental income doesn't cover the taxes, the insurance. In some states and locales, the taxes are expensive. The HOAs many times kick purchases out of the way, and you have to make up for that with more money down. So that covers it. And by the way, anything that I explain, that I talk about right here, I am happy to answer any questions at any time. So going forward, what are the loan programs? So what Brett started out in introducing me was the purpose of, what is the right loan for you and for your property. Part of what, that's my job. That's part of what I do. I have a form that I use to get loans pre-approved. I send that to everybody and anybody that calls me that asks for my help. You got to fill out that form that'll take you about 7 minutes to do. And that form will tell me where's the property, what's the address, what are the taxes, what are the insurance, what's the income, has it been bought before, at what price, what's it worth. We check out all of those things, and then we try to determine what lender is going to be right for that particular property. Now, some lenders won't even look at a property that costs less than $300,000. That's a fact. Some lenders won't look at a property that costs under $200,000. And other lenders, and I can count them on, in most of these cases I'm mentioning, there's only a handful of lenders in the business, so I can count in single digits the lenders that will do smaller loans for properties that cost, as little as, in some cases, $75,000 or $80,000. So we look at various programs. The common programs for the loans being offered are either 5-year, 10-year, or 20-year loans. So the 5 and the 10 are known as ARMs, adjustable rate mortgages, and the 20 and the 30-year loans are for those fixed periods of time. Obviously, the interest rates are higher for the 20 and the 30. and lower for the 5 and the 10. And if you really want a shorter term loan, I can get a 3-year loan. There's one lender or two lenders that offer 7-year, but most people will take either a 5 or a 10-year loan. And frankly, the difference between the rate on the 5 and the 10 is only 1%. The 5-year loan typically is about 7.5 to 7.75. The 10 years, 8.5 to 8.75. So sometimes for that extra 5 years, it pays to pay that higher interest rate, and that's what the rates range from 7.5 to 10%. The higher 30-year fixed are 9.5 to 10%, depending on the lender. And again, having done this for 20 plus years, I pretty much know who those players are. So onward and upward. Hopefully you have some questions in mind for me when we get down to the end. And non-recourse loans very often are what is offered when you're dealing with commercial properties. And in particular, if we look at Fannie Mae and Freddie Mac mortgages for multifamily properties, those are non-recourse loans. It is, believe it or not, easier to get a non-recourse loan if you're borrowing $1 million than it is to get a non-recourse loan if you're borrowing less than that. And there's logic to that, which we don't really need to get into at the moment, but I get questions on those, and I research them and determine what could be done. So as you've seen one of my examples prior, I did a non-recourse loan for a multi-unit property in LA as an example. So, and right now I'm actually working on a non-recourse loan for a client of mine that owns an RV park, an RV and campground. Very difficult to find a lender for that. They're not on the lender list, I can tell you that. They're in my portfolio. And I've actually got a client with a portfolio of multifamily and single residential properties worth about $4 million. And he is borrowing approximately half that amount of money as a refi cash out because he does not owe any money on that portfolio of properties. And he's going to use that $2 million to buy another portfolio of properties. But again, that's a really specific type loan, and I've already done the research. I already have the lender that's going to do that loan, and most of the lenders that I approached for that said no, they wouldn't do it. The lender I have is going to do one loan for the entire $2 million, and they're going to wrap the entire portfolio as collateral for that loan. And again, keeping in mind it's a non-recourse loan, and there'll be no recourse against the owner should there be a default, but he won't default because he's fairly well-to-do. Okay. So there are the types of properties you can invest in. We've kind of covered that already. Condos, 2 to 4 units, single-family residences. The property that you buy needs to be an investment property. You're not permitted to use it personally. If you do, and you get found out, you could be taxed, penalized. The IRS could consider it a distribution and tax you on the full cost of that property. But in essence, most people don't do that. And I guess, it's hard to get found out. The IRS doesn't police these things, but you don't want to take that chance. Not a good idea. And I might mention it on construction. Some people are interested in buying a piece of land and building a house on it and borrowing the money to do that. And I have arranged non-recourse construction loans, but you need to really have your ducks lined up. You need to have your plans, your permits, property needs to be zoned and entitled to be able to do that. So, prohibited transactions, that might be something that Sense Financial can also help you with. You're not permitted to, number one, combine personal money and IRA money to buy real estate unless, and this is, again, the specialty subject matter for Sense Financial, if you have the LLC set up, there is a way to do it. That's number one. Number two, you can combine IRAs, husband and wife, but the ownership in the property that your IRAs are being used to borrow the money and buy, they will have to be segregated on the deed. So your wife could own 50%, you could own 50% in your respective IRAs. So that's not prohibited. Same thing with, if your kids were involved, would also be permitted. And how does it work? I would leave that subject more to speaking with Dimitri's team, but essentially you set it up. And here's what I like about LLCs. So if you have a custodian, you still have to have a custodian to make sure that you're following the rules and regulations. But you do not have control over your money in your IRA if you don't have a checkbook LLC. If your custodian is managing the money, then you need money to pay a bill, you need to wire money or write a check. You always have to ask permission of the custodian to get that done. If you have a checkbook LLC, you have full control over the money. You can receive rents, you can write checks, you can wire money, you can receive and pay out of your IRA with checkbook control, and that is major. If it's something I would do, I would be doing that, not having the custodian. I don't need to pay a custodian to manage my money. I need to pay a custodian to oversee my actions and behavior, that I'm working correctly with an LLC company and following the regulations that the IRS stipulates. But bottom line, otherwise you're going to pay a fee, and you're going to have to wait to send money to the lender when it comes time to buy the property, or when it comes time to pay a bill, or when it comes time to order the appraisal. All those things take time. You have control when you have the LLC. So that's major. This is one screen that I think you're welcome to read, but I'm going to skip over that because it's more of a money example of a debt ratio for commercial property. But we'll go to the next screen because that's a little bit more symbolic of a typical transaction to purchase a investment property. In this case, property costs $450,000. If you put down 40%, that would be $180,000, leaving you with a loan amount of $270,000. And we're looking at a property that rental income was $3,500 a month. So if you figure the costs of the mortgage, the taxes, insurance, the management fee, it all boils down to a debt service coverage ratio. That's what is commonly called the DSCR. And you see it's over 1.2, 1.3 to 1, which would be a permissible transaction providing the lender's requirement was 1.2. If it was 1.25, I could probably get an exception with my lender. I have 10-year plus relationships with all my lenders. So if you have enough money in your IRA, you have enough reserves, we could probably get exceptions. And that's part of what I do as well. Make life a little bit easier on the road to investing. And in the case of a lower interest rate, like 7.5% instead of 8.5%, obviously your debt ratio is 1.3 or better. So with that example, we're hopefully you'll get the gist. Okay, here's a subject that does take a little bit more time to explain and digest. And it's one of my favorites because a lot of people, they see all of these issues about investing in IRAs and investing in real estate with their IRAs. Oh, it's too complicated. Oh, there's, too many problems. Oh, I can only get a loan for 60 or 50% instead of 80% if I just do it conventionally. Well, some of that's true. But if you understand the tax consequences or the tax benefits of having the investment in the IRA, with the IRA, you'll see that you can come out far ahead. So with that said, there are two aspects to it. There is the UBIT, unrealized business income tax. That affects the monthly income. So if you own a rental property, first of all, the first $1,000 of income is tax-free, tax-deferred, let's say, tax-deferred. And unless you're with a Roth IRA, then it's tax-free. So you don't pay tax on the first $1,000 of rental income over and above the expenses. And of course, you got to take into account any expenses for that property before you count your profits. Now, getting into the profits, okay? This is where it gets a little bit unruly to understand, but it really is simple. For every dollar of profit over and above your expenses, and again, understand, let's just take a 50-50 situation. You invested 50% of your IRA and you borrowed 50% of the purchase price. So you're in a 50-50 situation. 50% of that dollar profit goes back to your IRA. No tax. Tax deferred for a later date when you need the money, when you're old and gray like I am and you have to borrow, you have to use money to pay your bills, whatever. Okay? The other 50 cents of profit, because you borrowed 50% of the money, gets taxed at a trust rate of 37%. So the end result is about 17 cents of that 50 cents is taxes. So that's not too bad. On a dollar of profit, you're going to pay about 17 cents in taxes. Again, over and above whatever your expenses are. Okay? And with a good property and good rental income, that can mean thousands and thousands, tens of thousands of dollars that stay in your IRA and accumulate and compound year over year over year. And at the time you sell the property, which we'll go into the next subject of unrealized debt financing, when that percentage of ownership is increased because you've paid the mortgage for so many years, then the percentage of the profits on what's being taxed will be even that much less. It'll be a lot less than 50% of that 50 cents. So when it comes to the selling of the property, then you have what they call UDFI, unrelated or unrealized debt financing. And that comes down to the same concept when dealing with capital gains taxes. So let's, again, assume that you hold the property for 10 years Now you sell it, and you've got, well, let's just say $200,000 of profit, maybe more, maybe less, but let's use $200,000 of profit, and you have paid down about 70% of what you owe. So you got about a 30% balance left on that profit that could be subject to taxes. Again, that profit, capital gains wise, you're going to be looking at about, well, whatever the capital gains tax is, 15% of the 30 would be, let's just say half of that, so 30%. So you got maybe 60,000 going to be subject to tax, half the 60,000, and that ends up with maybe 15% of that number. So you could be somewhere in the tax range of $5,000 to $10,000 on a $200,000 profit, which would be a lot better than, conventionally speaking, if you had to pay 20% of the full $200,000 of profit, you'd have to pay $60,000 of taxes. So that's kind of, about $40,000 of taxes. So that kind of explains it a little bit more. You can read more about it. Again, I'd be happy to go over that in more detail at a future date and time.
I would like to add something here, if that's okay.
Sure.
If the property is free and clear of a mortgage for at least 12 months prior to the sale, then there would be no long-term capital gains on the proceeds. So if you do get the non-recourse financing, consider paying off the paying off the mortgage prior to sale and holding it for at least another 12 months. That's the way to avoid that. And then, yeah, that's it. But definitely,
Yeah, you're absolutely right.
and this is
And
tax stuff. So we always recommend, of course, like it says at the bottom, to consult your
yeah,
CPA for clarity
yeah.
on this. So,
I'm not a CPA. I'm not a specialist in taxes by any shape. I do have a law degree, but not by decree. I'm not licensed as an attorney, but I do have a law degree. So I have, over the years, accumulated a lot of knowledge and experience in dealing with these matters. So, and I'll always tell people to please consult your tax specialist or your attorney when it comes to these matters.
we probably have about 5 more minutes,
Yeah.
Mark. Just
Well,
if
this
any
is,
questions. So.
pretty simple. We're kind of wrapping it up, and you can see we've covered a lot of territory in a short period of time. These are things that I've spent hours and hours on. But what do you need in order to complete a loan package, get full loan approval? You can see on the screen everything from a lender's application. They do check credit just to make sure you don't have bankruptcies or liens against you. But other than that, credit scores don't really come into play in qualifying for the mortgage. It goes back to having enough money to cover the down payment, the reserves, the closing costs, and of course enough income on the property to cover the debt ratio. Purchase contract, closing statement from your purchase of the property. If you're refinancing as opposed to purchasing, then we like to have a closing statement when you bought the property. The lender likes to see that. Any kind of paperwork that has to do with setting up your LLC, articles of incorporation or articles of organization, and certificate of good standing, for example, IRA asset statement showing you've got good funds, title report. We always open up escrow, so we get a title report on the property to make sure that there are no unknown liens like I just had with this one example that I talked about it in the beginning of the broadcast. And of course, the appraisal, the only thing that you have to pay for in advance is an appraisal report. So the bank will order the appraisal once they have pre-approved the loan through my auspices, if in fact you're using my services. And that's usually $1,000. But in the case, just as a quick example, the portfolio that I'm working on right now has, I don't know, maybe 40 or 50 properties. I haven't counted them, but the bank required a deposit of $28,000 to cover the appraisal costs for all those properties. But again, that's the only payment required up front. I don't make a fee. I don't make anything unless the escrow closes. And they do require my fee agreement as well. So my fees are consistent with what the property cost, and I relegate that depending upon the higher the cost, the lower the fee. So I like to think that I earn my keep and try to help people from start to finish. Once you get the loan approval, that's where my job begins, really. And finding the right lender is only half the battle. You got to have the time to dedicate to dealing with the bank and everybody else involved, the title companies, the realtors, the appraisers, etc. Insurance, very, very important as well. So, Brett, I think I'm sensing we're pretty much at a Q&A period.
All right, let's do it. Let me stop my screen share. Stop sharing. There we go. Okay. Yeah, great stuff. Thank you so much. We do have some questions. And thank you all for putting some in the chat. Let's see. Amelia. Okay. I'm 30 and I do freelance work, multiple jobs at a time. Would you recommend a solo 401k over an IRA? Or are there benefits I can get in an IRA that I can't from a solo 401k? So, Amelia, there is a lot to what you just asked. And I probably don't have time to dissect it all here in this call. But if you want to schedule a consultation, visit our website. I'm happy to jump on a call. There's no charge for it. You'll walk away with value, I promise, whether you become a client of ours or not. The bottom line is the solo 401k is a superior product to an IRA in a lot of ways, but not everybody qualifies for it. And if you have to be self-employed, no employees outside of yourself and a spouse and other business owners if you have a partnership. If you have a Roth IRA, existing Roth IRA, the only option to self-direct that is a self-directed Roth IRA. That money cannot move into a 401k. Roth 401k funds can move into a 401k, another 401k, but not Roth IRA funds. So maybe that adds some clarity to your situation. Yeah, that's kind of all I got, Amelia. Feel free to add another chat question if you want one. Judith, this is for you. Probably Mark is asking, what was meant by defaulted for loans?
Sure. Well, if you don't make a mortgage payment, then the bank is going to come after you, and they're going to send you letters first or call you and say, okay, where's your mortgage payment? And if you somehow run out of money, you default, let's say your tenant moves out, you don't have the money to make the monthly payments. I mean, you can always negotiate some form of compromise, and I'm happy to help with that as well. But if you default on the property, then the bank can take control of the property over, within a reasonable period of time. Let's just say the typical foreclosure laws, I know in California where I'm located, once you get a notice of default where you haven't made the payments, then you have 4 months to bring your payments current. And if you don't do it within 4 months, then the property is subject to foreclosure and they can auction it off to the public for sale so that they can get their money back. the money that they lent you to buy the property.
Yeah.
Hopefully that
Lisa,
answers.
thanks, Judith, for the question. Lisa is asking, can we get copies of these slides? Yeah, absolutely, Lisa. This recording will go out. If you want a copy of the deck, I don't know, Mark, do you mind if we share the deck with somebody? Or
Not at all. If they can do a
Okay.
better job of presenting it than I can, I'm fine with that.
I'll have Lisa on next, so just kidding.
Yeah.
Judith is asking, are there any industries or property types that wouldn't be financed under a non-recourse loan? Industries or property types? Interesting question. Is there a list, she's asking? I'll put that on the screen so everyone can see it.
Yeah, property types. Well, number one, you can't get non-recourse financing for land, or farming is tough. I'm doing probably one of the most unique, if not the most unique, non-recourse loan I've done in 20 years this month, and it was just approved 2 days ago. It's with a private lending company that raises money for unique situations. And the interest rate, just as an example, is 11%. And it's refinancing. It's getting someone a loan, $550,000 for their RV park campground that's worth about $1.5 million. So it's about a 35% loan to value loan. And they have to throw in some other collateral for that. But more often than not, the banks won't look at a property like that either. Mobile homes are tough to finance because they're not attached to the ground. Commercial properties, I mean, there's probably a myriad of commercial properties that wouldn't qualify. I mean, if you had a nuclear facility, like we're talking about I don't think anybody would refinance the building of a nuclear reactor. So it gets kind of crazy.
Or the other thing that you can only invest in when it comes to your IRA 401k is what's legal. And it's not what's
Yeah.
legal by state, it's what's legal federally. And
Yeah.
marijuana farms and such are not legal federally. And so your IRA cannot own the marijuana farm. Now, probably your IRA could own the property but not conduct the business. I'd probably stay away from that, but I don't think Mark would be able to get you a non-recourse loan on a property where there's going to be a marijuana farmer in it.
Well, actually, let me make an exception to that because
Okay.
I closed a non-recourse loan for some people that I know on property where they were planting marijuana in California, and that loan was done right around just before the pandemic started. So late 2019, the purchase was $2 million, and I ended up helping the buyers borrow $1.2 million private money to make that purchase.
There you go.
And
Corrected.
that happened. That was probably the most rare non-recourse loan I've ever done.
By the way, if I could plug your service for a second, Mark, that's not something that you're going to be able to go through North American Savings Bank or any other bank. You need a go-between, a broker, if you will, like Mark, to be able to get a loan done like that. And actually, as he mentioned, he's going to save you a lot of time and effort, right? Like, he's the professional. He's going to help you do this. You're working a job. This is your retirement money. This isn't even something that you're going to get a loan on and then live off the income right now. So delegate it to someone who knows what they're doing and save yourself time, and time is money. So you're saving yourself money as well, and have it done the right way. But I'm not wrapping it up with that. I just wanted to say that. We do have a couple more. Marianne is asking, how long does it typically take for the approval and funding process? Is it the same as regular loans?
Yeah, I can answer that pretty quickly. So, in regards to what Brett just said, I just want to add that it never hurts to have an advocate for what you're doing. And it's almost like I think of the movie Rocky, where Rocky's got his coach in his corner. And Rocky knows how to battle and he knows how to punch, but sometimes he needs to use his right instead of his left. So that's part of why I'm here. But in terms of, I can make the pre-approval process go fairly quickly with the rapport that I have built over, a decade and a half or two with my lenders. I submit the information that you've given me about the property you want to buy, and I usually get an answer within the same day or 24 hours thereafter, later, for pre-approval. And then from there, if you're in agreement to employing my services, then I collect all the information that the lender requires, and sometimes I have to give you a little encouragement to get the loan application filled out, so on. But the sooner you get me everything from the loan app to your identification, your license, to your asset statements, the sooner you get all that information to me, the sooner I can get the approval of the lender, and then they'll issue a loan commitment letter, and then they'll ask you for a fee to pay for the appraisal. So all of that, it's usually within about a week. And the longer it takes to get the info from you, the longer the approval process. So it could be 2 weeks. But more often than not, the lenders want to get it done. And they appreciate the need. And if you're in contract and you have to close within 30 or 40 days, then we really have to move on it. But it does take, I like to tell people, it's at a minimum 30 days from the time we get the appraisal to close the loan. And that gives the lender enough time to review and approve the appraisal in relationship to the loan amount being requested, and get the loan docs done, line up the title company, line up the signing. So
Hey, Mark,
I like to say 30 to 40 days.
We're right at the hour mark. Are you okay sticking around for a few more minutes? There's still more questions. I'm okay with it if you are. Okay.
No, I'm fine.
That.
Yeah.
Okay, appreciate that. Want to be respectful of your time. Judy's asking, can you create an LLC with a solo 401k as a member and an adult child investor as the other member? Oh, good question. Good question. That's potentially could work, but it's not something that we're necessarily going to recommend that you do. There's a lot of complication there. If you're going to do the multi-member LLC situation with a disqualified party like your child, it's probably best done with an IRA, but you could technically do it with a solo 401k. I don't want to go too far down this rabbit hole, but the solo 401k, because there's no custodian requirement, we actually don't have to create a special purpose LLC or trust to give you checkbook control. You can actually have checkbook control right at the plan level. And so you're actually the trustee of the solo 401k, which gives you the ability to direct the funds, write checks, and sign on the dotted line, all that. So there's no requirement for an LLC. We could do it if you're worried about like limited liability for some reason, or you want to do like this partnership, but I'm going to push you back to a tax advisor before you go forward with a complicated setup like what you're asking. And bear in mind, whenever you have a multi-member LLC, especially for retirement accounts, it typically can't change once it's set up. So if you're 50% owner, your IRA is 50% owner, your child's IRA is 50% owner, or them personally, that it has to be shared pro rata throughout the life of that LLC. All the expenses, all the income, any assets that are held in there are 50-50 for the life of that LLC. It just adds some complication to it. So I would definitely urge you to go back and talk to your tax advisor before you pursue that kind of complicated setup. Raja is asking, or is saying, great info for a Roth solo. For a Roth solo 401k, do you avoid UBIT? Raja, so UBIT is triggered really in two ways. One, leveraged real estate in an IRA, and two, in an IRA and a 401k when you're conducting an active business, like flipping a bunch of real estate or owning. I heard of a guy that owned a bunch of Buffalo Wild Wings inside of his IRA. That's not a passive activity. That's an active business. So all that income is subject to the UBIT tax, which scales up to 37%. So it can be pretty hefty. Now, as Mark was talking about before, it's calculated. You can deduct expenses. And actually, it's not true to say that you can't take advantage of depreciation inside of an IRA. You actually can. It just doesn't trickle down to your personal tax return, but the depreciation is factored in as well as the expenses before the UDFI or UBIT is calculated on leveraged real estate. But Raja, in a solo 401k, there is no UDFI on leveraged real estate or UBIT on leveraged real estate, whatever you want to call it. The solo 401k is exempt from that. And yes, it has Roth, and yes, it has traditional built into the same plan. So there's no UDFI in that situation. It has nothing to do with the number of transactions you're performing each year. With one exception, you can probably get away with a couple flips inside your plan per year before the plan will have to pay a UBIT tax. That's a little bit more of a complicated topic. Talk to your tax advisor, but it has to do with what the plan is typically doing versus the flipping. If it's only flipping, you're probably going to end up having to pay the UDFI because that's the nature of the plan. But if the nature of the plan is to do a bunch of private money loans and then every once in a while you flip a property, that's not the nature of the plan. That's kind of an exception. You can usually fly under the radar of having to pay that UBIT tax on the flipped income. But again, CPA. Hopefully that answers your question. Sandra says, sorry, Brett, did you say no capital gains if we hold the property for 12 months in an IRA after paid off? Yes, that is exactly what I said. Thank you for that question. Mark, my IRA owns a fully entitled land parcel, and I'm searching for a construction loan to build. All lenders have told me they won't do construction loans. How can I get more info about you? Okay, you know what? Let me actually, and that looks like the last question. So let me share my screen again. I want to show Mark's contact info because I failed to do that the original time, but I want to do it for the recording as well as for everybody that's still on. Bear with me here. So here you go. And then Mark, anything else to add? I'll give you the last words, my friend.
Yeah, I do have a lender that will do construction, non-recourse construction financing, providing you've got plans already pre-approved. You're through the permit process, and so on, and there's 10 states that are precluded from that program. So it depends on the state that you're in or that the property's in. But I can send you information about that. Just send me your inquiry so I have your email address. Send it to mark@lendingresourcesgroup.com, and I will respond with that information.
Excellent. And I just want to note something here. If you guys on this call or later you're watching this 6 months from now, send Mark an email at that same email address, mark@lendingresourcesgroup.com, and he'll help you however he can, of course. But he also has an ebook that I've heard is pretty awesome. It's called "The 20 Most Frequently Asked Questions and the Answers Regarding Non-Recourse Loans for IRA Real Estate Investors." You've heard, obviously, a lot of that on this call today, but there's probably more in there that you haven't heard yet. So.
Right. Thank you, Brett. Yeah.
All right. Absolutely. Well, thank you, everybody. Really appreciate you joining us today. Got to figure out a way to efficiently stop the screen share. There we go. Judy says, or John says Oregon, by the way. That's the property where that land, or the state where that land is located. And then
I'll double check my list. I think Oregon is okay.
Awesome. John mentions, sorry, I know I said I'd give you the last word. I still will. John mentions, Brett, you mentioned a consultation. How can we get in touch with you about that? Hey, John, the easiest way is to just go to Sense Financial, like common sense, not dollars and cents, SenseFinancial.com, and then click on either the Solo 401k or the IRA drop-down menu, and then you can just book a consultation, like literally on any one of those pages. Take it away, John, or Mark, and then I'm going to close it out.
Well, folks, I appreciate the time. It's been a privilege and an honor to let me into your homes for this last hour. Hopefully, you've learned something, and I'd be more than happy to help you out in any way I can.
Thank you, sir, for being here. Thank you, everybody. Have a great rest of
My,
your day.
my pleasure. Thank you, Brett, for making it happen. And give my best to Dimitri and the team.